stock trading for less than 50 cents that sits at the exact intersection of two of the biggest fears and biggest opportunities in the entire AI industry right now: the global shortage of computing power and the explosion of AI-generated fakes that nobody can seem to catch fast enough. This company is building solutions for both problems at once, and the stock is currently sitting near its 52-week low after dropping roughly 80% over the past 2 months. I want to walk you through exactly what this company does, why it ran up dramatically last year, why it's crashed since, and what I think the setup actually looks like from here. Let's get into it. This company operates through two distinct divisions, and understanding both is essential before you can evaluate the stock as a whole. The first division focuses on distributed computing infrastructure, essentially building a marketplace that connects idle graphics processing units, the same kind of chips that power AI training and rendering workloads, into a shared network that other companies can rent capacity from. Instead of every AI company needing to build or lease its own massive, centralized data center, this model theoretically lets underused computing power sitting dormant around the world get put to work, with the owners of that hardware earning income in the process. The core problem this division is trying to solve is real and well documented across the tech industry. Demand for GPU compute has been growing faster than manufacturers can produce new chips, creating persistent supply constraints for companies trying to train and run AI models at scale. At the same time, a massive amount of consumer and enterprise-grade GPU hardware sits idle for large stretches of any given day. A marketplace model that connects that unused capacity with companies desperate for compute is, at least conceptually, an elegant answer to a real bottleneck. The question, as always with a company this size, is whether they can actually execute and capture meaningful market share in a space that bigger, better funded players are also chasing. The second division is where things get more interesting from a differentiation standpoint, because it's tackling a completely different but equally urgent problem: verifying whether digital content is real or AI generated. This division is building what the company describes as a trust and verification platform, designed to detect AI generated images, video, and audio, while also helping businesses confirm the authenticity of digital content before making decisions based on it. Think about how many industries now have to worry about this. Banks verifying identity documents, insurance companies processing claims with photo or video evidence, social media platforms trying to label synthetic content, government agencies screening for deepfake-driven fraud. The scale of the problem this division is targeting has grown enormously in a short period of time. AI-generated images, video, and audio have become sophisticated enough that regular people struggle to distinguish them from authentic content, and that gap is only widening as the underlying generation technology improves. We've already seen real-world examples of AI-generated footage spreading rapidly online during moments of geopolitical tension, racking up massive view counts before anyone could confirm whether the footage was real. That's not a hypothetical future problem. That's happening now, and it's exactly the kind of environment where a credible, fast, enterprise-grade verification tool becomes genuinely valuable. So why does a company addressing two legitimately large growing problems trade for less than 50 cents a share with a market capitalization sitting in the single-digit millions? This is the part of the story you need to sit with carefully, because it's the difference between a genuine opportunity and a value trap. Both of these divisions are still in early stages. The compute marketplace has to prove it can attract enough supply and demand simultaneously to function as a real marketplace, not just a concept on a pitch deck. The verification platform has to prove its detection technology actually works reliably at scale across the kinds of adversarial, constantly evolving AI generation techniques it's meant to catch. Early stage execution risk is the single biggest variable sitting underneath this entire story. Let's talk about the stock's actual price history, because it tells an important story on its own. This stock went on an enormous run from around the end of last year into the following spring, gaining several 100% as excitement built around both divisions of the business. That kind of move on a stock this small tends to attract exactly the kind of momentum-driven trading interest that can push a name far beyond what its current fundamentals would justify on their own, purely on the promise of what the business could become if execution goes right. But what goes up that fast on a stock this size often comes back down just as violently, and that's exactly what happened here. Over the past 2 months, the stock has fallen roughly 80% from its highs, landing right back near the same level that acted as a support zone before the original rally even started. That's a brutal round trip for anyone who bought in near the top, but it's also the kind of setup that value and reversal universal-focused traders pay close attention to, because a stock returning to a previously established support level after a huge speculative run can sometimes represent a genuine rebasing point rather than a broken story. Here's the technical case for why some traders are watching this level closely. When a stock falls back to a zone that previously acted as a floor, and the decline has pushed technical indicators deep into oversold territory, that combination sometimes precedes a bounce, especially if there's no fundamental reason the underlying business itself has gotten worse. The key word there is sometimes. Oversold conditions can persist much longer than logic suggests they should, and a stock can absolutely keep falling through a previous support level if the market has genuinely lost confidence in the story, not just gotten ahead of itself on hyper. So what would actually change the fundamental picture here rather than just the technical one? For the compute division, the signal to watch is whether the company can demonstrate real, paying usage of its marketplace, actual GPU capacity being rented and utilized at scale, not just partnership announcements or platform launches. Marketplaces are notoriously difficult businesses to bootstrap because you need both supply and demand showing up at the same time, and a compute marketplace with plenty of available hardware but no renters, or plenty of renters but no available hardware, doesn't generate real revenue no matter how good the underlying technology is. For the verification division, the signal to watch is enterprise adoption. Building detection technology in a lab is one thing. Getting a bank, an insurance company, or a government agency to actually deploy that technology into a live mission-critical workflow is a completely different and much harder challenge, because those industries move slowly, demand extensive validation, and have almost zero tolerance for false positives or false negatives in a fraud detection context. If this company starts landing named enterprise customers or formal partnerships with recognizable institutions, that's the kind of catalyst that could justify a re-rating of the stock. Right now, that proof point is still largely ahead of them rather than behind them. I also want to address the size comparison that naturally comes up with a company like this. There are much larger, well-established players in the broader digital trust and cybersecurity space. Companies valued in the tens or hundreds of billions of dollars, focused on data analytics, threat detection, and identity verification for large enterprises and governments. This company is operating in a similar conceptual space, but at a fraction of that scale. That gap can be read two ways. Optimists see enormous room to grow if even a small piece of that addressable market materializes. Skeptics see a massive gap in resources, credibility, and enterprise relationships that a company this small may simply never be able to close against much better funded competitors. Let's talk about the compute infrastructure side one more time, because there's a comparison worth drawing to help frame how this model actually works in practice. Distributed compute marketplaces function conceptually similar to how distributed mining networks operate in cryptocurrency, aggregating scattered individual hardware into a collective resource pool that generates value at scale. The difference is that cryptocurrency mining has a single, simple output, and a compute marketplace has to manage far more complex logistics around latency, reliability, security, and workload matching between whoever has available GPU capacity and whoever needs to rent it for a specific task. That added complexity is exactly why execution matters so much more here than the underlying concept. Now let's talk about what this stock's low market capitalization actually means. From a risk standpoint, separate from anything to do with the business quality itself, a company valued in the single-digit millions of dollars is, almost by definition, thinly traded, meaning relatively small amounts of buying or selling pressure can move the share price dramatically in either direction. That cuts both ways for a trader. It means a positive catalyst, like a major partnership announcement or a demonstrated revenue milestone, could send this stock sharply higher on relatively modest buying interest. It also means continued disappointment, or simply a lack of news, can keep the stock drifting lower with very little resistance, because there isn't a deep pool of committed, long-term holders defending any particular price level. I want to be honest about the financial picture here too, because a fair breakdown requires it. This is a company that, based on its financial profile, remains unprofitable, which is completely normal for an early-stage technology company running two ambitious, capital-intensive divisions simultaneously, but it also means the company remains dependent on either revenue growth accelerating quickly or continued access to outside capital to keep funding both businesses through this development stage. Small companies in this position sometimes need to raise additional capital through share issuances, which can dilute existing shareholders, an important variable to watch for in future company announcements and filings. So here's how I think about balancing the opportunity against the risk. On the opportunity side, you have a company positioned at the intersection of two genuinely large, genuinely growing markets, GPU compute scarcity and AI content verification, both of which are structural trends unlikely to reverse anytime soon. You also have a stock that's fallen back to a level that previously served as support, sitting in oversold territory after an 80% decline from its highs, which is exactly the kind of technical setup that can attract renewed buying interest if sentiment shifts even modestly. On the risk side, you have a company still in the early stages of proving out both of its core business lines with no guarantee that either the compute marketplace or the verification platform reaches the kind of scale needed to generate meaningful, sustainable revenue. You have a market capitalization small enough that the stock can move violently on very little actual trading volume in either direction. And you have the financial reality of an early stage, likely unprofitable company that may need continued outside capital to keep both divisions funded through this critical proving out period. If you're the kind of trader drawn to early stage, high-risk technology names trading near multi-month lows, this is a name worth adding to a watch list heading into whatever the next major company update turns out to be, whether that's a partnership announcement, a usage milestone on the compute side, or an enterprise adoption update on the verification side. If you're more risk-averse, this is a name to watch from a distance until there's concrete evidence of revenue traction rather than just conceptual promise, because right now the story is still substantially ahead of the proof. I want to close with the same reminder I give on every stock like this. A company can be working on a genuinely important problem in a genuinely large market and still see its stock price collapse if execution lags behind expectations or if the broader market simply loses patience with the story before the fundamentals catch up. This is a micro-cap stock with real binary risk built into both of its core business lines, and it should only ever be sized as money you can afford to lose entirely, not as a core position in any portfolio. So there it is. A company building a decentralized GPU compute marketplace on one side and an AI content verification platform on the other, sitting near its 52-week low after an 80% decline from a run that saw the stock climb several 100% just months earlier. Hideaway Digital Corp, ticker HIDE on the TSX Venture Exchange, and HIDDF on the US OTC market. I'll be watching for the next real catalyst, whether that's a usage milestone, a partnership, or a financial update to see which direction this one breaks. If you want that update the moment it happens, subscribe now so you don't miss it.